G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Please sure check out my links below, including exchanges I use and social media content that I post. All right, let's go. Okay, so the topic for this video, we'll be going over the jobs numbers just came out yesterday. So very big data to watch out for, and this was a very interesting read that came out. And so the unemployment rate in non-farm. You're also looking at some other charts, SARM rule, where we're at with that. We haven't checked that one for a while. And yeah, it's Bitcoin, the S&P, and the yields to finish off. So let's get cracking with this video. So first up, we have the data, of course. And my time in Australia, non-farm payrolls came out at 11:30. And the consensus estimates were 160,000, and previously was 212,000 for the month of December. And December reading came in at 256,000. So absolutely blew out estimations, just smashed them out of the water, which is a good sign for the labour market. It's still resilient, it's still strong in these interesting times that we're living in at the moment. Inflation in Australia particularly is pretty high. But the US is lower, and it's in the 2 percentile range, because we're well above that. So yeah, we have that reading. And then unemployment rate came out exactly the same time, and the consensus was 4.2%, and previously was 4.2%. So consensus was predicting it would stay flat for the month of December, and it came in at 4.1%. So quite not a huge drop, but it's 0.1% drop. So really it's a minimal drop, and that's a good sign too for the labour market, seeing the overall US, all states, has come down by 0.1%, and non-farm smashed to the water, which is fantastic. All right. Now we have participation rate, which is pretty standard. Nothing to say about that one. Okay, and that's pretty well it. We had consumer sentiment come out, Michigan, and it came in at 73, which is a bit below consensus, so it's not too bad. And that's all we got. So that's the labour market data. So we'll go on to the unemployment rate now. And there it is there. Like, this is all graphed out, of course. And we can see we have periods of green. It's bullishness and bearishness. Obviously, if it shoots up, it's not good for the stock market. If it goes down, it's good. And right now we're sort of bottoming out, and it's sort of rounding, and it's starting to shoot. So it started to go higher. It doesn't mean definitively it just shoots up. Like this period here was the pandemic, which was absolutely unexpected. And from January to March, it was just boom, like a straight line essentially. So it's very unusual. So every other times it's sort of gradually it does take off like a parabola. But not this crazy, of course. And I'll just bring up the recessions to show you what occurs. Oh, we can't do that. Too many indicators. All right. Too many indicators. So I bring up the recession indicator there. And you can see every time it goes from red, to green, recession. All right, 2008. Obviously, this one here, the pandemic one, which was absolutely ridiculous, but it did cause a recession. Right now, we're sort of about to sort of enter that, but not quite yet. Hasn't been declared. It's always when after it happens, it gets declared. So they're always late to the party. That what's the recession people can't remember what they're called, but the Bureau of Statistics or something like that. The NBR, I think the NBR, National Bureau of Statistics, calls recession, I believe. So. Yeah, so anyway, it goes from red to green. That's the 2008 financial crisis. From red, you can see there, to green, that's 2001, dot-com bubble, and unemployment rate shot up. And again, you see, it goes from red to green, and that was 1990 recession. All right, and then this one was a bit different. It was a back-to-back recession in the 80s. So you had from red to green, we had a recession in 1980. And then it went flat, and then went red again, and then went green again. And then was it green, boom, recession again. So it was 80, 81, 82. It happened here. I'm not going to go too much. I'm just going to do two more. So red to green, and that was it. That was a recession. That was a pretty bad one in the mid-70s. And then red to green, sideways, down, and then a proper move up, and then recession in 1970. Okay, so that was 1970 recession. And yeah, so that was all times the unemployment rate started to take off, form a proper base. Okay, so it has to form a proper rounded off base, and then starts to move up. It goes green and it goes straight up, a straight line. Starts to really it's like a parabola. Once it gets momentum, it can't be stopped until the Fed step in and save the day. What is the Fed? And recessions occur. Okay, so you get this base and it shoots up. Base, it shoots up, and then it formed a base here and it shot up again. So you see this pattern play out time and time again. But this trend ribbon really gives you, it gives you a good idea of what's going to happen, especially now. But just fill these ones out, and you get these basing patterns, and then it takes off. The pandemic that wasn't even a base; it was just a straight line up. But now we sort of get this base formed. Okay, but will it lead to a recession immediately? Or will we just chop around sideways, and then this is going to January, I should say, if you've got to zoom out, but the data is a bit skewed. It stretches all the way out there, but it's really, see how short this is, 2 years here, but that's one whole year. So you can't draw it. 2026 would really be here where March is, okay? So you can really start to take off and so do something like that, and then it'll be a recession, okay? Session will be here. We'll see. Otherwise, so I don't know yet, but it was good to see 4.1% it came in at, okay? So the 4.2 previously, and we are trading sideways, and that's good for now. Okay, if this year accelerates and gets crazy, but we'll have to really track this data very closely. Next one, we've got SARM rule. Okay, this is it triggers once it crosses the 0.5 line, as you can see the yellow line there. Every time it crosses that line, so the pandemic one, and I'll just put it on automatic drawing mode. See it crossed here. What happened here? I'll bring up the, what I'll do is take off these indicators again. I've got too many on my charts, and scroll down. And every time it goes recession, so the red's recessions, recession here, across the 50 line, recession. 50 line, it was a bit later. Session was earlier, but nevertheless, it was confirmation by that stage. That was 2000, of course, 2008, 991, cross and recession, of course. The 80s back-to-backs, so recession was caused here and here. Quite accurate. This is a bit late, but happened again in the 70s and then 1970. And you can go back. I can go back to a long time ago. So here it occurred, 1960. Here, 1958. We'll come back to this one. 1953 session. So it worked every single year, even here in the late 40s. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. All right, sessions. It worked every single time perfectly. But the one I just said I'll come back to was this one here, 959. It was a fake break and went back down again. So this could be occurring, something like this. So October 59, it durably broke, and then it came back down in November, and then definitively broke down in January, and then it didn't crack back up until August that next year. So we get something similar like that playing out into late 2025, 2026, somewhere in time 2026, and this being where we are and breaking back down and then coming back up to confirm that we are, recession is definitely coming, but this was a fake out nevertheless. So out of 13 recessions, there was 12 that were accurate and 1 was not. All right. So see, it broke above the 0.5 line quite clearly there. Okay. Just needs to break back up again to confirm recession, but at the moment we're below it. So good signs for now. And the SARM rule was falsely triggered there like it did back in 1959. Okay, so that's important to note. And for now, we are in the clear for the almighty bull run. want to see in crypto, and a good year for the stock market. But yeah, that's important to note. So Bitcoin now, and I'll go to the daily time frame. And on the job number news, it did go up. Okay, it stayed flat really. So we did come back to this bottom, and then the data came out, and we bounced from there. But is this a durable bounce? No, it could still break down, of course. And I did mention in a previous video that the 1st of January, the first video of the year, I did say that we're forming a head and shoulders. I said that was the head, a shoulder, head, and this could be a right shoulder. But I was wrong. We went high. Actually, it was around here. Sorry, I would have called it. So it was the 1st of January. Okay. So yeah, right here. This was forming, or this already formed, and we're breaking down. It could have been this one here, and I was saying that this would break down. Yeah, that's probably more like it. Yeah. So this here, and then it would go down, but we had a pump, and now it came back down again. So yeah, interesting times, and that was basically a larger right shoulder. So still a head and shoulders, but just a weird looking right shoulder, and this could still break to the downside. And I do see this dragging to the downside, unfortunately. Just in the short term, because you've got these wicks, it could take liquidity, all right? Either, what I'll do is I'll clear the drawings again. What I can do is it could take liquidity, all right, and then go up, and then take off the raises from there, or it could break lower, come back down to this wick, right, at the 85k level, break a little bit lower, and then come back up, all right, and then take off. And away we go. I don't know how it's going to play out, but it's a little bit liquidity in the day. It needs fuel to keep going and change direction. Liquidity fuels the next runs up or down, either way. We do have this big area here, and it could come down to here. It's probably the worst case scenario. These lower highs, and then the market comes down to here. That would be pretty bearish. Don't really want to see it coming down to these levels, late 60s, mid 60s. Okay, I don't see that really happening. I think it's too far gone now, too far away. And the data of the job market seems pretty strong. So it's all about inflation numbers next week. If they're really, really bad, then we can really see a sell-off down to here at the worst. But I don't see it's going down to 70, 60k range, mid 60s. So yeah, this is it for me. This is the most bearish scenario. Or the most bullish scenario is you get a good inflation reading next week. All right, we take liquidity here, and we take off. All right. So that would be the bullish scenario, and the bearish scenario would be this one here. All right. And this could take a bit longer to play out. I don't know how long, roughly. But yeah, there's two scenarios there. That one there and that one there. And that is Bitcoin. Okay, so yeah, this head and shoulders playing out as I did predict on the 1st of January. So I did say it was coming down, but I didn't see this move, particular move here. I did not see this coming, and then back down here. I just thought it would break down straight away. I was wrong. Okay, but yeah, we're seeing it come back down here now. Decision time, where you've got a lot of supports. You've got one here, you've got resistance here, you've got support, we have supports, support. When you touch a level that many times, what happens? When you kick a door that many times, what happens to the door? It breaks, okay? So you're going to break down. It's inevitable. It's tested this level, and it has to break it. It's sorry to say that, but that's what I see happening. It's a bit more pain in the crypto market for that factor, okay? So S&P, we have a red day on the S&P. So even though Bitcoin sort of went up, bounced, the S&P went down. And you can see quite clearly here, I had a trend line drawn, all right, from all the way back in October 2023. Touched here, obviously, started a trend line somewhere. That was a correction we got, all right. That was July to October, the Q3 correction. And then it went below. So I just try and match up the best point touches. So you go logarithmic, it looks a bit better. log chart. Okay, so touch, touch. And now we've come back to it here. Okay, formed the support. And so we've broken it just about. This could be a fake out and continuation higher of this trend line. So you've broken below the trend line. Or what I see happening, unfortunately, is there's a gap. There's a gap and there's another gap here. Yeah, there's two gaps that haven't been filled. And we haven't even filled this one. So it comes down to 57.81 and then down to this support level at 56.50. Will take us down there, of course. Oh, it's green. You want it nice and red for the bears. And that would send us down a further 3%. So it's not that bad in relative terms. And from the top, that would be a 7% correction. So very small. This correction we got back in August of 2024, last year, it was 10%. So that was even worse. All right. And that was a quick shakeout and a continuation higher. This could be quick and over and done with very soon, And then off we go in February and then take off, So it doesn't have to be the end, this breaking this long-term trend line. But yeah, it's just to scare people. I think this is over and the market's going in recession. The economy is going in recession. The markets are indicating that. I don't see it happening until 2026, okay? So that's my thoughts on that recession, fears and all that. But yeah, so the gaps filled and come down there. And then we got the Russell. There's no real gaps to fill on the Russell. They're all been filled, okay? But I do have a support line down at 2,000. I should really draw another one. Probably, interesting. Probably around, I don't know. If you look at the S&P down 7% to where its support level is, Russell, theoretically, I wouldn't say it dropping 20%. It's just a bit too much compared to the S&P. It probably drop. It's already down 11%. Okay, so it's already dropped a hell of a lot, and it could come down somewhere in the 15% realm. I don't know exactly. It's a bit hard to predict on the Russell. Something like that. You see, you got the resistance levels here. One there. Okay, and one here, and one here. All right, so that could definitely form support, right, around 2,100, which is a nice round number. I might say that actually, that support level, 2,000. I do think that's out of the cards. That's too low for my liking, and definitely 1,640. That was just a low. I just marked down for future preferences. If we get down there in the future, which I do think we probably will get down there if this recession gets really, really bad. But who knows? It could be never come back down there again. All right, so this is now resistance 2290. All right, as you can see there, he's heavy resistance here, support and resistance. So it's quite clear, and I do see it's coming down to here. All right, and that's that one. So that's the Russell and yields. Now this is a pattern that plays out. And I've mentioned this in the previous video, the 1st of January video, I believe it was. And we have this downwards consolidation. And it's like a triangle pattern sort of thing. And we come up to it. So you start here, come up to it, and then you sort of get struggled. And then it breaks through quite clearly. If I can click on it properly, it breaks to the upside, yeah? Make that green. And away we go. Happened here, tops here in October 2023, May, and then again November, and then we're broken through. Okay, so we'll see how high it goes. Yeah, get this arrow correct. And on the jobs numbers that came out, if you go on the daily time frame, you can see it's a nice fat green candle. So the bond market is seeing something different to what people think. Okay, the job numbers were good. And non-farm and the unemployment rate, obviously quite impressive. I think quits were good. New entrants, all these numbers were good. I haven't got the data in front of you. All that stuff was good. But the bond market sees something different, and yields shooting higher is a sign that they're thinking the Fed has cut 100 basis points, which is more than what they should have done. they shouldn't have to cut rates at all. The job market is strong, and they've cut too soon. I think the bond market's saying that they've cut too soon, and potentially inflation is going to start taking off, and that's what they're fearing. That's what I'm seeing here. I watched the previous video. The guy who made a video about it, Benjamin Cohen, I don't love, talked about this in his video, and he's an expert, and I go off him. He's a brilliant analyst, and no one better than him. He's the best. So the yields is shooting up like this, breaking this level. I do see it going to the top, unfortunately. So more pain for the stock markets if this does occur, and we can come up essentially, and then sweep the high, and then maybe go down, and that would pretty well be it. It'll come down, and that'll be good for stocks and the crypto market if we do see a sweep and then a drop in yields to normalise back down. Okay, there's more demand for bonds at that stage. But at the moment, they're demanding higher yields. As this is a general sign. The long end of the yield curve goes up. So this is a 10-year yield. You got the 2-year, which is more closer to the Fed funds rate. The 10-year is not really controlled by the Fed. It's the open market. And when it starts to break away from the 2-year, like the way it's doing it, it's all about growth and inflation. So it's predicting more inflation coming when it's shooting up like this. Okay, so it can be a good thing for the economy, but it's contradictory to what you think, because I think the Fed's done too much damage, or haven't have cut too soon, and it's gonna re-accelerate inflation. Okay, the job market's still strong, inflation's still relatively low, so I do think this is a short-term fearful event for the bond market. And it'll spill over the stock market. So that's breaking out there, and I'll overlay so you can see what I'm talking about. Okay, so there's the S&P 500 in orange. Okay, as soon as we broke out of this C consolidation pattern, what happens to the stock market? When it broke out, the stock market went down. Yeah, so that went down, and the bond market went up. Was the yields. Then we had a consolidation, up, down, up. And we broke through, and what's the stock market doing right now? You guessed it, it's going down. It's going down, and it's breaking out yields. You go back even further, same thing happened here. We had a consolidation pattern. Okay, here. 2021. So we broke through. It went back down, retested, and then it shot higher, of course. Yields, and it continued higher all the way to here in October 2022. So quite a long stretch. We had inflationary concerns, of course, then. So similar thing we're seeing now. So the bond market's front running inflationary concerns, and let's see at the bottom is the top of the bond market. So it topped and this bottomed. Okay. So yeah, when it broke out of that consolidation pattern and just shot up higher, the stock market just shot down and corrected 20%, and that was that 2022 period, and the yields just went through the roof. Okay, and I'll show you one more just to nail the point home. Okay, and this was the 2017 period, so 2016 December. All right, touch, just about. Okay, and we struggled here, and then we broke through. Right, as soon as we broke through, hang on, get this right. This consolidation pattern, and shot up, and I'll change it to green so you can see the point. What happened to the stock market? Stock market topped and corrected and struggled for a while. Okay, so it went down in 2018, and it went sideways for a considerable amount of time and didn't break this high until really it was August. And so from January to August, so 8 months later, and it broke, and then eventually we did crash down in late 2018. Okay, and so did yields. Yields dropped too. Okay, they continued to fall, and the stock market went up. But that's a different matter. When you bring in inflation and unemployment rates into it all, it's a clearer picture for the bond market. and that is that there in 2017. Okay, that was that period. And yeah, so particularly this period here, 2023, 2022, when they had that high inflation, and we could see when the bond yields up and stock market down, it made more perfect sense, and we're getting something similar now. And will we top here at close to 5% and take out these highs, this red one, and then eventually the headwinds that we're facing at the moment, the stock market and crypto market getting absolutely pounded by the yields in the bond market, and then eventually it will go down. And then it'll be a tailwind. It'll be good for assets, for risk assets, particularly like Bitcoin and the crypto market, to accelerate the upside. So that is the bond market, and that is the overall video. So cheers. So hope you enjoyed this one. Hope it was exciting enough. Talking about job numbers and with inflation, the Fed, and different markets, S&P, Bitcoin, yields, the bond market, and just seeing what, obviously the SARM rule, that interesting indicator. I haven't looked at that for quite a long time to see if we're still below the 0.5 line. So far we are, and that's a good sign for now. Economy's still holding up strong, but the bond market's sort of freaking out. That's looking at the Fed going, why'd you get 100 basis points when the job market's still strong? I do see the fears of inflation accelerating again. It's what my best guess is being when the yields are shooting up the way they are. What I did back in 2022, we had inflation take off and the yields just went through the roof and the stock market dropped. So that's sort of similar playing out again. Hopefully not, but we'll see. So that is the reason why getting risk assets selling off is the yields going up and breaking out the consolidation pattern that I talked about. So that is the video. So we'll have to wait and see. The inflation numbers come out next week, and that is crucial data. It's so crucial. If it comes in hotter than expected, then you'll see a continuation of selling off. If it comes in less, then I think the markets will reaccelerate upwards, which is good. But it's very, very crucial data next week. Look out for that one. So if you enjoy the video, please smash the like, comment your thoughts below. Please smash the subscribe button and stay updated. And check out the links below, and I'll catch you next one. Cheers.